Nio Inc. ADR New York Stock Exchange is currently trading at $4.84 USD as of Friday, January 30th, 2026, marking a significant intraday gain of 5.34%. This move comes on the back of heavy trading volume and a shifting narrative surrounding Chinese electric vehicle manufacturers. While the headline figure of 4.84 USD might look like just another green day in a volatile sector, the underlying reality is far more complex. Most investors looking at Nio stock right now are focused on the immediate delivery numbers, but the real story is the massive software deployment that just hit the fleet. The launch of the world model NWM 2.0 system into live vehicles has fundamentally changed how the market is pricing Nio's autonomous capabilities. Everyone expected a slow climb back to the $5 mark, but the integration of this tech has created a curiosity loop among institutional desks. They are no longer just looking at Nio as a car company, they are evaluating it as a software-defined mobility platform that might actually have a lead on global rivals in urban navigation. The common belief you'll hear on most investing sites is that Nio is a perpetual cash incinerator, a company that builds beautiful cars but can't seem to stop the bleeding on the balance sheet. This perspective has kept the stock pinned in a low range for months. The reality I'm seeing, however, suggests a massive disconnect between that old narrative and the new operational efficiency. If you look at the recent institutional activity, there is a quiet but steady accumulation. While retail traders are busy looking for the next Nvidia stock or Apple stock breakout, smart capital is moving into the individual brokerage accounts of those who recognize that Nio is currently trading at a fraction of its historical sales multiple. The market expects a struggle, but the reality is that Nio is hitting a production cadence we haven't seen before. With the Firefly sub-brand preparing for its European debut in places like Luxembourg next month, the volume of vehicles on the road is set to scale beyond the luxury segment. Recent stock movement has been dictated by more than just raw delivery stats. We are seeing a high level of sensitivity to the Nasdaq Golden Dragon China Index, which has been dragging most ADRs up with it. But Nio is outperforming its peers today because of the specific catalysts within its own ecosystem. The rollout of the Banyan 3.3.0 update and the Cedar platform enhancements for the ES8 has fixed several friction points that previously annoyed the user base. This matters for the stock because user retention and service revenue are becoming a larger part of the valuation model. When you open your Robinhood app or check your SoFi Invest dashboard, you might see the price flickering, but what you aren't seeing is the 91% completion rate of the Onvo battery pack expansion. Nio isn't just selling cars, they are building a proprietary energy grid. This isn't the same company it was 2 years ago. The business model remains centered on the concept of battery swapping, a strategy that many Western analysts originally dismissed as too capital-intensive. Today, that skepticism is meeting the reality of the CATL partnership. By standardizing battery modules across multiple brands, Nio has lowered the barrier to entry for its ecosystem. This move toward intelligent portfolios of energy assets is something that Fidelity Wealth Management and other major firms are beginning to model as a long-term defensive moat. If you can swap a battery in 3 minutes while a Tesla stock owner is still waiting for a supercharger to ramp up to full speed, you have a functional advantage that directly translates to consumer preference in dense urban environments. Comment below how many shares of Nio Inc. ADR you currently hold in your portfolio. I'm curious to see if the sentiment here matches the price action we are witnessing on the floor of the NYSE. Looking at the institutional side, we've seen some interesting shifts. Fidelity ETFs and various Fidelity mutual funds have maintained a presence, but the real aggressive moves are coming from the likes of Morgan Stanley, which recently reiterated a bullish stance with a target that implies a massive upside from these levels. They are looking at the 2026 roadmap, which includes the ES9 and the Onvo L80. These aren't just incremental updates, they are the vehicles designed to capture the middle market segment that Nio has historically ignored. The expectation was that Nio would stay a niche luxury player, but the reality is they are making a play for the volume that defines winners in the global EV market. Interactive Brokers trading data shows a significant uptick in call option activity, centered around the $5 and $6 strikes, suggesting that traders are betting on a sustained breakout past these levels. For those using online investing tools or seeking investment help, it's important to understand the macroeconomic pressures still at play. Trade tensions and the 5% tax hike on certain energy vehicles in China are real risks. However, Nio's battery-as-a-service model provides a unique hedge. Since the battery rental portion isn't taxed the same way as the vehicle purchase, Nio effectively offers a lower price point for high-end consumers. This is the kind of detail that is often missed in a standard press release, but is paramount for anyone doing self-investing. Whether you're using the Robinhood trading platform or the Fidelity mobile app, the data points you should be watching are the monthly delivery growth rates relative to the burn rate. If Nio can maintain a 40 to 50% growth rate through 2026 while limiting R&D expenses to 2 billion yuan per quarter, the path to non-GAAP profitability becomes a reality rather than a dream. The history of this company is a series of near-death experiences followed by massive capital injections. From the 2019 cash crunch to the recent billion-dollar equity offerings, Nio has always found a way to bridge the gap. Critics will point to the negative gross margins on some models, which have reached as low as 33% in certain quarters, essentially meaning they were losing money on every unit. But that is the old reality. The new reality is a target of 20% gross margins, driven by supply chain savings and the higher margin software services that are now being activated. When you look at the Schwab Intelligent Portfolios or other robo-advisors, they often lag behind these fundamental shifts, focusing on trailing 12-month data. But a forward-looking analysis shows a company that is finally growing into its massive infrastructure. If we shift to the future outlook, the catalysts are lining up. The expansion into 40 countries by the end of this year isn't just talk. They are opening showrooms in Hungary and preparing for a massive push into the broader European market. This geographical diversification is a risk, certainly, but it's also a necessary step to decouple from the singular risks of the Chinese domestic market. We are seeing a tension between the market's expectation of a Chinese slowdown and the reality of Nio's accelerating global footprint. If they can successfully launch the Firefly brand at that $30,000 price point, they will be competing directly in a segment where there is currently very little high-quality competition. This is where the real upside potential lies for those who have the patience to hold through the volatility of the ADR structure. As we look toward the next few quarters, keep a close eye on the Chinese New Year delivery numbers. February is always a seasonally weak month, but the January numbers we are seeing suggest that the ES8 is still commanding a strong lead in the premium segment. The Interactive Brokers platform and other professional tools are showing that short interest is still present, which creates the potential for a squeeze if Nio continues to beat these low expectations. The market narrative has been so negative for so long that any sign of consistent operational excellence is treated as a major surprise. That is exactly the environment where expectations and reality collide to create significant price movement. In summary, the central insight here is that Nio is no longer just a struggling startup. It is an infrastructure-heavy technology firm that is beginning to realize the benefits of its long-term bets on battery swapping and autonomous software. The contrast between the expected bankruptcy and the reality of record deliveries and software breakthroughs is the primary driver of the current 5.34% jump. We've moved from a period of speculation to a period of execution. The authoritative take is that Nio has built the foundation, and 2026 is the year we see if that foundation can support a profitable house. Whether you're managing a Fidelity IRA's account or just trading on the Robinhood app, the focus must remain on the long-term convergence of their service revenue and car sales. The volatility will remain, but the depth of Nio's ecosystem is finally becoming a visible asset rather than a hidden cost. We've seen how the expectation of a stagnant Chinese market has been challenged by the reality of Nio's technological lead in the NWM 2.0 rollout. This is a company that has survived the worst and now is positioning itself to thrive in a more efficient, software-driven world. Keep your eyes on the volume and the upcoming European launches, as these will be the definitive indicators of whether this move to 4.84 USD is a temporary bounce or the beginning of a sustained re-rating. Financial disclaimer: this content is for informational and educational purposes only and should not be construed as investment, financial, or other advice. Investing in stocks and ADRs involves significant risk, including the potential loss of principal. Past performance is not indicative of future results. Please consult with a qualified financial professional before making any investment decisions. Don't forget to like this post, leave a comment with your thoughts on NIO's future, and subscribe for more deep dives into the EV market.